Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined today by Josh Mahony, market analyst at IG Group, and as always, a pleasure to have you in the studio. We're going to take a little bit of an overview or look into the year end and really how the markets are going to move over, well, the next month and a half. So you've kindly brought along a few slides. Just talk us through what you've got here for us, Josh.
Yeah, exactly. So the sort of first part of the presentation is more about the current overlook. The past week and a bit has essentially seen a number of different central banks, or pretty much all of the major central banks coming out with their current standpoint. And it's pretty much laid the groundwork for a long period of time. We've seen the likes of the ECB, the Bank of Japan, the Bank of England, the RBA overnight as well. Everyone now seems to have their outlook pretty much stabilised. We've got a number of reasons exactly why that is the case on this slide. But the one that we haven't necessarily got stabilised at the moment is the Federal Reserve. And of course, that's going to be a lot more of a moving part going forward compared to any of these other central banks. And that's why I think that we are going to see a big focus on the US, given everything else is pretty much going to be static for the coming months. So the next slide, we're going to be talking about the FOMC and the US tax reforms. So of course, everyone pretty much expects to see us raising rates at the back end of the year, 92% market expectation now on a December rate hike. Of course, Janet Yellen's now going to be leaving at the beginning of next year. So given the fact that we've seen a dot plot at the beginning of the year alluding to 3 rate rises, this is her opportunity to actually nail it down and actually deliver what she said she was going to. Last year was a bit of a failure. We only saw 1. This year we could actually see 3. Of course, now that we've got someone else coming into the hot seat, there's going to be the questions around how quickly that pace is going to be moving. But of course, Powell is already an FOMC member, so it's not necessarily going to be a massive shift in all likeliness, and therefore there is still a chance we could see another 3 rate rises for next year. That compared to, like I said, all of those other central banks where we're not going to be seeing anything, and that interest rate differential, of course, plays into the FX markets. And then we're talking about the US tax reforms. We've got, the first sort of initial outline of what the bill could look like. It's going to take a little bit of a while. The expectation is that we're going to hear something from the Senate in terms of their proposal by the end of the week. This is going to be something that's going to be played out. It may not necessarily be a sort of clean sweep that they're immediately just going to say, yep, that's great. It's probably going to take a few iterations and a few conversations, but it's going to be at the forefront of investors' minds. And certainly as we get forward in towards the back end of that process, and we've seen Donald Trump alluding to the potential to get it passed by the 23rd of November. So far, he's not necessarily been too successful at doing exactly what he wants with his bills. But if we were to see that passed, then that again would put less pressure on the Federal Reserve to actually need to keep pumping up the economy, because then we're going to be pushing it more onto the fiscal side rather than the monetary side. So again, those two put together, the potential for big tax reforms, the benefits that would bring to the US stock markets and potentially to the sort of everyday person's pockets, alongside the expectation that we could see substantial rate rises going forward in the US, should build a picture for a strong end to the year and a beginning to 2018.
Well, let's have a look at the dollar index, and this obviously a key indication of if we're seeing interest rates go up in the US, we can expect the dollar index to outperform. Dollar out of favour for most of this year, but it seems to be rallying into the close in the final months. Just from a technical point of view, just talk us through what we're looking at here.
Yeah, certainly. So, we did drop below that key 92.53 mark, but crucially, you can see on the bottom end of this formation, we have got descending lows, much in the same way as we've got ascending highs. So we've got this sort of broadening formation. Now, we have started to move back towards the upside, and you can see those previous 2 candles at the bottom of that sell-off are giving us sort of that indecision reading. Those are the kind of candles that you see at the bottom. Certainly, if you look at the sell-off that we did see for the preceding, say, 7-8 months, all pretty sizable bodies. Then all of a sudden we come into this bottom, and then all of a sudden we have these very small bodies, large wicks. And off the back of that, and we've rallied out of that, we've now posted this strong green candle. Now we're moving into a lot more of a bullish phase. Now, this market is essentially made up of the US dollar against a handful or sort of basket of currencies. The biggest determinant of that is going to be the euro. And so if you look at this chart versus euro dollar, generally you're just going to see the inverse. This is the daily time frame with the euro. It's pretty much what you're going to see inverted for the daily time frame of the dollar index. And what we can see now is that we've been breaking below this neckline for this head and shoulders formation in the same way that we've done exactly the same on the dollar index, and now starting to pick up steam. So, you know, it can take a little bit of time to work through these things. It takes a bit of time for people to believe that this market that keeps going up is all of a sudden going to keep going down. And I feel like we're moving out of the back end of this head and shoulders formation. We're going to start moving into a phase where people are going to believe in this dollar rally, and that's why I think that we could have a very strong period for the back end of the year across a number of currencies. The next chart we've got should be cable. And again, I wanted to take it out to the longer term outlook. You can see that we've had actually a very strong 2017 so far, but it's taken us back into these crucial lows. You can see 2009, you can also see 2001 on the left hand side of the chart. That's pretty much marked the top of the market so far, and we've started to see some weakness. Stochastics rallying in towards that overbought territory at 80. So there is the potential, of course, that we have topped out here for cable. The next chart should give us a little bit more in terms of what to look out for to tell us that we have done so. So you can see here in terms of the weekly time frame, we still do continue to create higher highs and higher lows, but that break of the 12773 is the one thing that will really show us that actually this trend is over in terms of the gains we've seen throughout 2017, and that we're likely to see some significant downside. I don't think that we're going to get any sort of decent deal out of EU negotiations, and as time rolls on and we do less and less and less and nothing actually happens in terms of these negotiations, I don't see how that's going to be positive for the pound.
And this is FTSE, yes. I mean, there's been a lot of reverse correlation between strength in the pound, weakness in the pound, and the FTSE. And the FTSE really, when you look at the likes of the Dow and the DAX, it's been out of favour and seems to be kind of caught in that what is the pound itself going to do, and that's dictating what the FTSE is going to do.
Yeah.
Where can we go from here, though, if we have a breakout?
Well, I think the interesting thing about this is that if you look at the European markets, they seem to be a lot more heavily determined by where their currencies are going. Certainly the FTSE 100, we're not necessarily seeing that same kind of thing in terms of US markets. They keep going up despite the fact that you know, we're now starting to see some strength coming back into play for the US dollar. What I think is the case is that people in the US are focusing more on what's happening to their economy, what's happening in terms of the tax reforms, and that's going to mean for the US stock markets. In terms of the UK, we're focusing a lot more on how beneficial that a weak pound can be. So if we're looking for the effects of a weakening pound, a weakening euro, you're going to likely see an outperformance in terms of the FTSE and the DAX. And at the same time, we're also seeing, if we do see the US actually sort of cross the threshold in terms of those tax reforms, then that should be beneficial for the US market. So whilst I do think we are going to have a strong period for the FTSE 100, that doesn't necessarily mean that we're going to have a negative one for the US, because I don't think the US markets are necessarily being driven by currencies in the same way that we are closer to home. And certainly we can see that we have broken out towards the upside. We haven't taken out that 7,600 mark, but the fact that we did break through that previous swing high, for me, means that we're pretty much waiting to do so. As we start to see this pick up in terms of the US dollar strength story, and we see the weakness in the European currencies, I think we're going to have a big outperformance in terms of a lot of these stock markets. Another key way to be looking at it is, of course, if you wanted to trade the FTSE 100 versus the FTSE 250, FTSE 250 is going to be more domestically focused, whereas you're seeing the more internationally based FTSE 100. So as if we see the negotiations in terms of the EU and Brexit start to go south, you're likely to see the FTSE 250 suffering pretty heavily, as we've seen recently, the likes of, you know, consumer spending, retail sales and the like, not necessarily doing too well. That's more likely to hit the 250 than it is the FTSE 100. I think the FTSE 100 and the DAX and the Dow, for different reasons, are going to be rallying towards the back end of the year and the beginning of next.
Super. We might see the dollar rally as well into the year end. On that note, very insightful as ever, Josh Mahony from IG Group. Thanks for joining us today.
Thank you.